BP shares in London hitting their lowest point since 1996 this morning, under pressure here in the U.S. as well. Is this a company truly in distress? Well, our next guest says credit and distressed debt provide great opportunities if you find the right companies. That's what he's in the business of. It's David Barse, President and CEO of Third Avenue Management. Now, I know you've got a big portfolio here, David. I want to get through the names, but let's start on the news because BP, there's a ton of concern out there about how they're going to be able to pay all of these legal costs, the escrow account and the like. You like BP right now?
No, not necessarily. We do not. We actually don't know enough about the situation or have a real sense of certainty as to how this is going to get resolved. So for us, BP is one of those, let's watch it, let's look in the periphery. What are other companies being affected either positively or negatively from what's happening in BP and, in fact, in the moratorium on deepwater drilling in the Gulf? Obviously a benefit to some land drilling companies and other service businesses onshore, which we are investors in. This is a helpful thing, although that's not the way you really want to make money in a company investment by what's happened with BP.
Because I was looking at a transcript of an interview you gave last week where you said BP was a great company.
Well, we think it is a great company. It's a big company. And before this unfortunate disaster, it was generating tremendous amounts of free cash flow.
But it's not one you put money into right now.
Not at all.
Even in credit. Talk to me, though, about what you are finding opportunities in, because you make a business of going out there and looking for distressed companies that you think do have the ability to perhaps turn themselves around.
Right. Well, we say we like to buy what's safe and cheap. It's really that simple. We need a good, strong balance sheet, great management, a business we understand, and we need it to be trading at an inexpensive price that is a discount to what we think is intrinsic value. When we're buying distressed debt, we need to be at the top of the capital structure. We want to go into a company, look at its value, figure out what its assets are worth, and then pick that security in the capital stack that we think is going to participate in the reorganization. So some of the things we're doing today, like Lehman Brothers, a company that's been in bankruptcy for almost 2 years.
You don't hear too much about it, other than in a historical sense.
Yeah, people don't want to talk about it, but it is an interesting situation in that you have unsecured claims. Basically, the capital stack there are a bunch of bonds, but they're all fairly similar in terms of the capital stack. They're trading at around 20 cents on the dollar. There's a plan of reorganization disclosure statement that have been filed that proposes a payout. They actually project that they're going to pay 17.4 cents. So why is the debt trading at 20 if they're projecting that they're going to pay out 17.4? We think that the company's management currently that's in operation is very conservative.
Despite the fact that courts are still, looking at this. Barclays chief was just testifying yesterday in New York courts about this. That doesn't concern you?
Well, it's interesting, right? If in fact they determine that Barclays got too good of a deal, they may have to pay some more money into the estate. That money will flow down to creditors in the waterfall. So there are different opportunities there. We think that it's a long-term payout, but your downside's fairly well protected here, and you have some real upside. If that reorganization process moves quicker and the payouts occur faster, you'll actually do a lot better than where it's trading in terms of an IRR basis, an internal rate of return. So we're kind of interested in this and watching it very closely.